what is my Duolingo price target as of May 2026? So let's look into it. First, this is not a DCF. I think DCF, discounted cash flow, are useless. Why I think is that? Because you find your target price and then what? What do you do with that? It's completely useless, because if the current price is lower than the target price, then you buy. And then when the stock price achieve that target price, what do you do? Do you sell? And it's mathematic that the stock price will go like 2 or 3 times higher than that, right? So it's completely useless. You find a number, you don't know what to do with it. And this is even more true if we are talking about a growth stock like Duolingo, because it's so unpredictable what the business will do over 5 years. So it can change, like what today is X, to in 6 months is 2X, and in 9 months is half X, right? So completely useless. So what I have developed is my model that I call 4 dimensions valuation model. So what is the first dimension? First dimension is your thesis. So I have my thesis on Duolingo. You need to write it down. I did it. You can find my thesis, if you follow me, on lorenzo2cents.com. So go there. There is a lot of content about not only Duolingo, but even about Duolingo, and you can read what's my thesis about Duolingo. Why? Because you want your valuation to be yours. I mean, if you use the value and the estimation from analysts, it doesn't make any sense. Just buy S&P 500, right? So you develop your thesis, and this is the first dimension. After that, and you, by the way, you write it here down in the normal case narrative. You here write a short summary of the thesis, right? Then this is the dimension number 1. Dimension number 2, 3, 4 are these 3 scenarios: worst case, normal case, and best case. So let's start from the worst case scenario. Actually, let's start from the normal case scenario. So normal case scenario has 50% of probability of happening. So what of course, this is qualitative, but when you put your assumption here of growth, of operating margin, you need to think that way, like what numbers have 50% of probability of happening. That is quite high, right? And then you put the number here. So this should be the scenario that is not too bullish, it's realistic, because it's 50%, right? So if my thesis happens, then I think this is how this is going, right? And you start, this first column is actually here is 2025. I should put 2026 now, but it's not that important. Here, this column is LTM, last 12 trailing months. So now it's updated at Q1. So here you put first an estimation of the TAM, because you want to be sure that you are realistic. So when you go here and see after 10 years what is the market share, it's 2%. Yeah, it's realistic. Of course, if you get a number that is 90%, it's not realistic. There is some mistakes in your model, right? So this is just, doesn't need to be 100% accurate, the total market, the total value of the market, total addressable market value, but it's just a test to see, one of the tests to see if your assumptions are realistic or not. Then these you just complete with real data, take from your brokers, wherever you want, Yahoo Finance, wherever. So revenue, operating margin. Then you have this value that is the one important to be explained now, that is operating cash flow to operating margin factor. So as this is a discounted cash flow, you want to have the cash here, not the earnings. So how do you, the problem, I mean, a lot of people, what they do, they use very simple models that again doesn't make any sense, are completely useless. So they take the free cash flow and then they apply a growth rate to that free cash flow. Completely useless. Why? Because normally growth companies at the beginning of their trajectory have very low earnings or negative earnings and very low cash flow. They are prioritizing growth. So you cannot apply, you will never get to any number that has a meaning if you apply growth rate to the cash flow. You need to apply the growth rate to revenue. So how do you get from the operating margin that you want to think in terms of to the cash flow? Yeah, it's quite pretty simple. You just you look at the operating cash flow and you divide it by the operating margin and you find a conversion factor, right? And you put it here. This is calculated. So Duolingo today has 163 million of operating margin and 431 millions of operating cash flow. So that's the number that is calculated. Now here you put the capex that I have divided between maintenance and growth capex. It's not explicitly this way anywhere probably. So this is my assumption, but in this case is irrelevant in the case of Duolingo, but in the case of high capex business, think about, I don't know, Mercado Libre or any company, or even about Nebius, any company that invests a lot to build the infrastructure that is needed for their business. Then it makes sense to think in terms of how much is the capex that they are spending to grow and how much is the capex that they are spending to maintain the infrastructure. Why? Because at a certain point they will decide they are mature enough to lower the spending for growth. So it means that you can lower the spending for the growth capex, but you still need to maintain the maintenance capex. This is why I've split it. But in this case, you just consider the total capex is fine. And how I then evolve the capex here, I just make it grow. Of course, you can make different assumptions, but I just make it grow at the same pace of the revenue, right? So this take the same multiple revenue growth rate here, but you can make different assumption, but this is how I'm modeling it now. Then tax rate doesn't really, I think, do nothing on the model, even in interest paid. I just here for reference. And then you have the free cash flow that is calculated. Of course, it is operating cash flow minus capex. So this is the picture as of now, right? As of Q1 2026. Then this is where your assumption became fundamental to the final result. So first, now Duolingo has almost 15% of operating margin. So why I'm keeping it low next year and like 7-8 years to comes, and then it's just increasing, growing back in the last part of the 10 years? Well, because now they said we are focusing on growth. So I expect that the operating margin will go down, right? So it's going down to 10%, then it's staying to 10% for 3 years, then it starts recovering, and then it grows until 27%. And here, why 27? Well, for instance, I am looking at some benchmark. I put it, everything is here, like Netflix, right? But you may look at different companies. So you think about a company that could have a similar operating margin to Duolingo when DUOL will be mature, right? So the growth will start to slow down. There will be more interest in monetization, and you put it normally for a growth company, you consider it around the end of the 10 years. It's a quite conservative assumption, I believe. Then, second important assumption is the growth, the revenue growth. Actually, this is even more important. So what I'm estimating is 20% for the next 5 years, and it's 18% for the second 5 years of the 10 years. You may say this is bullish compared to what they are getting now, because they are getting for, I believe, or 10 or 12% for this year, something like that. Yes, it is bullish, but my thesis is bullish again. This is not, I'm not listening to any analyst here. Otherwise, I will buy an ETF on S&P 500. So this is my narrative and this is my model. So the model, the normal case scenario follows my narrative, my thesis, right? So these are my considerations. And then after 10 years, so from year 11 to 12, this is the growth rate. I think they will keep growing, 14%, not that exciting, but still above the TAM growth rate that I've estimated in 5%. So still gaining market share. At the end, after 10 years, Duolingo will only have 2% of the market. So it's plausible to think that. And then after 20 years, growth rate will be perpetual to 5%. It's quite conservative assumption. So you see here, I am calculating for year 10 the free cash flow divided by revenue. Why? This is the second test, right? First test to see there are no big mistakes in my model was the market share. Second test is this. Well, if these factors, if this percentage would have been like 90%, of course, my model was wrong. Cannot be. So this still has to be plausible. Okay. So we have found the first intrinsic value of Duolingo for the normal case scenario, that is 50% of probability of happening. Then you do the same, and this should be all according to what you have written here, to your narrative, right? So second is the best case scenario. So here, same number. This is pulling numbers from the normal case scenario. So I need just to update once here. What does it change here? Well, mainly operating margin. It's still 10%, but then it gets more bullish as we move toward 2035, and it ends up to 33%. Sorry, guys, one important thing I didn't tell before. These OCF to OM factors, of course, now it's pretty high. It's 265% because the company is growing. Somehow profit are deferred compared to cash flow. This happens often, but still I'm doing the assumption that in the future operating cash flow will be more aligned to operating margin. So you see that this becomes 130%. Even this factor has a lot of impact, so pay attention. Free cash flow on revenue is 41%. It's bullish, of course, but this is the best case scenario, and this has 25% of probability of happening. So you need to think that way, right? Okay, growth 25% for the next 5 years, and then again 25% flat. And the terminal multiple, I didn't say this. This is very important, actually. You have the same here is 35. This is what multiply the last year free cash flow, and you find basically the terminal value, no? And so this is very important. Best case 35, normal case is 24. So normal case quite conservative. Best case quite bullish, but still reasonable. Why? This is probably the most important. This is calculated on the base of the growth rate that you put here. This is the most important number, because probably between 70% and 90% of the value that you calculate here, the valuation comes from the last year multiple, so not from the free cash flow that you see here, right? That's because for a growth company, it's not generating so much cash flow as they are in hyper growth. Okay, so this is very important. Like if you put here instead of 35.70, you get a value of the company that is probably around double. So this is making all the game here, right? So still, you don't need to touch it. This is calculated, but it's calculated on the base of the growth rate that you put here. Okay, that's good. And then you have the final dimension that is worst case scenario. So worst case scenario, thesis is rejected. So I was wrong, basically, right? You see here, the Lorenzo to Sense thesis is rejected. Duolingo remains a solid digital language learning hub, but it does not become the default global learning platform, and blah, blah, blah. So you need to take this in consideration. And here, again, you have this scenario has 25% of probability of happening. So what you are saying is that my thesis has basically 75% of probability of happening, 75% I am right, 25% I am wrong. So your thesis needs to be well taught, right? You need to be pretty sure about that. If you say, okay, but I'm not sure, then don't invest in the company. No financial advice, guys. No financial advice. Let me repeat it. So what does it happen if my thesis is rejected? Well, Duolingo will keep growing 10% next 5 years, then we'll slow down to 8%, and then we'll keep basically around 6 to 3% perpetually. Quite fair assumption. 16% of free cash flow to revenue, even here quite fair, probably now is even higher than that. Yeah, so feel good makes sense. Now, you have done this. This is all calculated. So here, this is basically remaining unless there is a big swing in the change in the market interest rate set by the Fed, or any macroeconomical impact like COVID, interest rates go to zero and this kind of stuff. If not, I leave this pretty much unchanged. So this is, of course, what is needed to discount the future cash flow to the present value. It is used for that calculation. Net liquidity is the net financial position of the company. So basically, it's cash plus investments less debt. I have a shortcut to this. I normally take market cap less enterprise value, and it should be that number. So I avoid to spend time in calculating it. Then current market cap, you need to insert it here, and outstanding shares, and then the projected annual dilution over years, in 10 years. Again, as you are applying this to the end of the 10 years, this is not really accurate, but it doesn't matter because this is not accurate. This is just a blueprint that you want to build to know where is the price now, right? So this is the final result. You get the final price with dilution. This is without dilution. You get the final price for the worst case scenario, best case, and normal case. So your worst case, you see that is around 50% of the price that is now. So my thesis is rejected. I lose 50%. Ideally, best case it's 7x, and normal case is 2x. This has normal case 50% of probability to make a 2x, and 2x, 25 of making a 7x, 25% of losing 50% of my investment here. So this is how I use this. I don't have a single fixed number that doesn't tell me anything, but I have, you see, these 3 to 4 dimensions that tell me where the price is. Is it very cheap now? Well, it's pretty cheap because we are close, even if I may still lose 50%, but we are much closer to the worst case scenario than to the best case scenario. So is it an asymmetric investment? This is what all this model answer is about. Is it an asymmetric investment? Oh, well, yes, this is the answer. Then how I use this? Well, normally I use this not to decide if to open a position or not. That decision is almost solely made on the base of my thesis. But I decide on the basis of this how much to allocate to the position. Of course, the closer it is to the worst case, the more I allocate, and vice versa. And I may even decide to trim if this is too close or even above the best case scenario. So this is, guys, how I use it. Now, if you want to get this model for use yourself, just go to lorenzo2sense.com. I share it in my last, and I will probably share it in all the next articles that I will write. There is a link to click in the article where you can get to join basically my Telegram group, and there you can get for free the access to this content and even more than that. Guys, no financial advice here. Do your homework. Ciao.